Be sure and use these 5 killer loan programs in 2025. Real estate agents and buyers have got to know some of the new things that are going on this year. With all the tightening and difference in mortgage rates going up and whatnot, it's been up to the lenders to kind of figure out how to make things a little bit more, come up with some creative ideas to make housing more affordable. So in this video, I'm going to break down 5 of the killer loan programs in 2025. And make sure you stay to the end because I do have one that has been literally shaking the ground. Let's get started. So 2025 is loaded with new options, but the best ones aren't always obvious. Number 1 are zero down programs. Now, this is kind of broken up into VA, USDA, and then there are state-specific bond programs. Let's address VA real quick. If you do qualify for VA benefits, there is no other loan that compares. I mean, it's no money down. There's no mortgage insurance, which is this crazy criteria that lenders impose on you if you put less than 20% down. The rates are a lot lower and the guidelines are a ton more flexible. And so with 2025 coming around, it was maybe a couple of years ago, the VA made a change where there was no loan limit. So you can get 100% financing. Many lenders are even going up to $3 million or even beyond that. It's a great, great loan, and it's the best loan on the planet. The second loan out there with no money down is the USDA. The United States Department of Agriculture has a loan, but there is a little bit of a nuance, meaning that you have to buy in a USDA eligible area. There is a website, just Google USDA eligibility map. On this eligibility map, you can plug in any address and it'll tell you whether or not it is eligible or not, with either green for good and red for bad. I think that's what they do. In any event, the USDA almost mirrors the VA loan, meaning that it has no money down, has really low interest rates, but it's not as flexible. In fact, you have very, very strict guidelines as to how much money you can make on a USDA loan. They do it by how many people are in your household. And the other thing is they have very strict guidelines with their debt to income ratios, just kind of how lenders look at your overall debt and your income together. So USDA is still a very good option if you qualify. The third option for no money down are bond programs or different state housing programs. Now, in Virginia, they have one called the VHDA, and it is accompanied then by these other, we'll call them grant programs. What you do is you combine these government bond programs with these down payment assistance programs in order to have no money down. Some of them give you these grants that need to be repaid. So when you go to sell your house, some are literally just forgiven. So it's important to look. Every county has their own program with regards to these no money down deals that are out there. Most of them require you to be a first-time home buyer, and they pretty much all have an income limit that you can make. And every county is different. So if you're asking, make sure you ask your lender, if you are a first-time home buyer, what programs are available to me as a first-time home buyer if I'm looking to buy in such and such county. And they should be able to tell you. The second program are temporary buy-down programs. This is become very, very in vogue given that interest rates have been very high. So what buyers are doing, they're negotiating with the seller to temporarily buy down their interest rate. This is not like paying points or having a permanent buy down. It is what's called a temporary buy down. Here's how it works. So there are different ones. There is a 3-2-1 buy down, there's a 2-1 buy down, and then there's a 1-0 buy down. Let's look at the 3-2-1 buy down because I find it to be the most interesting and most helpful for making your housing affordable again. What it does is you just take whatever the interest rate is the lender has. Let's just call it 6.5 for gigs. Well, what the 3-2-1 buy down will do is it'll take your rate in the first year from 6.5% to 3.5%, so 3% lower. In the second year, your interest rate would go from 3.5 to 4.5, and then in year 3 from 4.5 to 5.5, and then years 4 through 30, you have that final rate of that 6.5%. Now, why is this good? Well, obviously, because your payment is a lot lower. Now, there are some nuances because the seller typically will have to pay for much or all of these buy down costs. And what you typically will do is build this into the rate. Now, there is a way to do this. So anybody that just says, and I know realtors get a little bit nervous when you start talking about temporary buy downs and building stuff into, building closing costs into the sales price. That's what you have to do, but it's not as difficult as it may sound. And I have a very specific way to do this. In fact, if you'd like to have my way of doing it, I have a spreadsheet, comment spreadsheet, and I will send that to you. But basically, it calculates out the 3-2-1 buy down and exactly how to negotiate it into your offer. You don't have to scare the seller up front with it. You don't have to worry your realtor about it. Just work with your lender and how to execute this 3-2-1 buy down. And a lot of times you don't have to change anything about your contract. The third programs we're going to talk about are what we call non-QM. This has become quite popular of recent, especially this year, as interest rates have gone up and a lot of guideline changes have been made, especially with regards to second homes and investment properties. Let's just call them, there are three main, I'll call them non-QM programs that I'm seeing that are, from my chair, being very, very beneficial to the borrowers. The first is a bank statement loan. The second is a DSCR loan. And the last is any loan for a second home or an investment property. I'm going to take this one first because it's kind of easy. Years ago, the agencies started to have problems with second homes and investment properties. In fact, second homes used to have the exact same interest rate as a normal 30-year primary residence rate. It was just the same rate. There was no benefit. So what were people doing? Well, they were lying. They were saying, I'm going to go ahead and live in that property, and they never were. They actually were just going to have it as a second home. And so fast forward to today, what you're seeing on your typical scenario is that if you tried to get a second home now and putting, let's say 20% down, the agencies would whack you with a bunch of fees, higher rates, extra points, closing costs. It's just atrocious. But what happens in the non-QM world is that for both second homes and investor loans, which these agencies really hate, Fannie and Freddie, they hate them. Well, these non-QM lenders are like, well, bring them on. Because we're going to underwrite the old-fashioned way. We're going to look at their overall debt-to-income ratio. We're going to look at their credit. I mean, you got to kind of fit the box a little bit. But for a high credit, good credit score, good borrower, this loan has rates that are right around, if not at, the 30-year fixed rate, the normal 30-year fixed rates. So if you're looking at buying a second home and investment property now, have no fear, non-QM is here. Another one of the non-QM loans that are very popular are bank statement loans. These are perfect for business owners that either don't want to show you everything or, quite frankly, can't show you everything because if they do, they wouldn't qualify, right? So maybe it's an income issue, maybe whatever, but the business has a lot of cash flow, right? So what we do is we look at the business bank statements for anywhere from 12 to 24 months. The popular one is 12 months. Just take 12 months of business bank statements. So what we do is we take all your business deposits and we then take all of that up and we divide it by 12. That's the number of the basis that we look at for the income to qualify for this loan. Now, there are a couple of nuances in how we actually calculate it with the debt to income ratios on that. But when you're using business bank statements to qualify for a loan, it makes it a lot easier. And what about the rates? Well, this is a non-QM loan. It's not that bad. We're barely more than the normal 30-year fixed rate loan. So, and with a lot of flexibility. So bank statement loans, absolutely wonderful. The other and the last non-QM loan I'm going to talk about today is the DSCR loan for investors. This has become hugely popular. Really what it does is it says they don't qualify the borrower, they qualify the property. And the rates don't have to be 10, 11, and 12% with a bunch of points. You shouldn't be paying that. And if you are, you're talking to the wrong lender. No offense, lenders that do that. I'm sure you do a lot of good things. I'll probably get flamed for this, but whatever. You don't need to be paying 12% for a DSCR loan. In fact, your rates should be closer to maybe a half to a full percent over what the normal 30-year fixed rate is. And if you have any questions about DSCR loans, go ahead and leave me a comment. And I know there's a lot of gray area here with DSCR because it has to do with how much the home would rent for, all that jazz. It's not just cut and dry, you get a better rate. But DSCR is like the name of the game for investors now. You can do it for a fix and flip, maybe rates a little bit higher, or you can do it as an investment property where you're going to buy and hold, which that's where you're going to get the better rates. But if you have any questions about DSCR, please leave me a comment. The last program I wanted to leave you with is the 40-year loan. Yes, I said 40 years. I personally believe that fast forward 1 or 2 years, 40-year loans are going to be the thing. This is exactly what happened when you look back at when mortgages came into existence. There were no 30-year mortgages. I mean, look at even in some countries don't even allow for 30-year mortgages. It's like, pay me back in 5 years or I'm going to, I don't know. But, now we have 30-year mortgages. People sometimes choose 15-year mortgages if they want to pay less interest and pay the home off faster. But now, because 30-year mortgage, even with a 30-year loan, stretching your loan term over 30 years, which lowers your payment, the longer your term lowers the payment, just like your car loan, things like that. The longer your term, lower your payment. It's still not affordable. And a lot of people are still feeling the pinch because of the high interest rates. So what has been the solution? A 40-year loan. So you stretch it out 10 more years and it drops the payment even more. Whatever the rate's going to be, it's about 0.25% higher than a 30-year fix. So an eighth to 0.25%. It depends on your credit score, to be frank. This is non-QM, so it's not like it doesn't move with your normal market. It's kind of like if there's a lot of demand, maybe the rates are going to go up a little bit and things like that. But regardless, a 40-year loan is like a very, very good product. There's not a lot of options when you're trying to buy big mortgages, jumbo loans, over the conforming loan limit, and you don't have the 20% down payment. That's a lot of people, by the way. Or maybe you just have your cash tied up. You don't want to put 20% down. So you're buying a $2 million house. Well, guess what? You don't have to put 20% down. You can put 15% down and still not have any mortgage insurance. In fact, it's very common with all these non-QM. There's no such thing as mortgage insurance. I mean, these mortgage insurance companies won't even touch this product. So what do? They just have to build everything into the rate or make the qualifying box a little bit smaller in order to get that right type of buyer that's not going to default. Anyways, 40-year loans, it's awesome. Now, I promised you something really cool at the last part of this. And I want to change gears here and mention something for home sellers. I've recently launched a product called Project My Home, which is where we as the lending group and my company is partnering with the seller to help make that listing a specialty listing. A lot of markets, just home buyers are not able to afford the mortgage. So we really came up with this program to help make housing more affordable. And that's really it. So what we've done is on every one of our approved listings, we have put a free 1% off the first year of the loan. No seller concessions. It is what it is. So if you've been looking around and you want to find one of these homes, all you have to do is go into Zillow and go into the More section and type in the remarks, project space, my space, home, and pull up the map and it'll show you all the available listings. Now, we are just getting this started, so you may not find a whole lot in your area. So if you want an idea of what that would look like for your specific listing, and I would love to talk to your real estate agent about that, just mention that in the comments and I'll be sure to get back to you. You can always email me and call me, but this is a way that we have really made every listing a specialty listing and help make housing affordable again, because it's tough when you've got 7% interest rates out there. And quite frankly, in any interest rate environment, who wouldn't want 1% off your mortgage? So those are the 5 main programs you should be looking for in 2025 and beyond. Sound like Rick Lightyear. But if you're not talking about these programs and inquiring about them, you're probably missing out. So make sure you are checking with a good lender and asking about these different options that are available for you, and get with a really solid real estate agent that can help you navigate this crazy environment. But this is Rick Elmendorf, and I'll see you on the next video.